Good morning, everyone. Today we are going to discuss intangible assets under LKS 38. This is part of our financial accounting course and it is important because many modern business depend on intangible assets more than physical ones. Let's start with the definition. Intangible assets are identifiable non-monetary assets without physical substance. That means we cannot see them or touch them like land, buildings, or machinery. But even though they are not physical, they still have value and they can help a business to earn future income. Some common examples include software, patents, trademark, and goodwill. For instance, think about Microsoft. Its software like Windows and Office are intangible assets. Or take Coca-Cola. The formula for the drink and the brand name are examples of trademarks. These are not physical objects, but they generate huge value for the company. Now, how do we recognize intangible assets? LKS 38 says that there are two important criteria. The first is that the assets must bring probable future economic benefits. In other words, it should help the company make profits, reduce costs, or give some other financial advantage. The second is that the cost of the assets can be measured reliably. If we cannot measure the cost, then we cannot record it in the financial statement. Let me give you a small example. Suppose a company develops a new software program. If the company expects that this program will increase sales or reduce expenses, and if the development cost can be calculated, then it qualifies as an intangible asset. But if the company only has an idea for software and no reliable cost estimate, then it cannot be recognized. Next, let's look at measurement. Measurement has two stages, initial measurement and subsequent measurement. At the initial stage, intangible assets are recorded at cost. Cost includes the purchase price as well as directly attributable cost. For example, if you buy a patent, the cost will be include the purchase price, legal price, and registration cost. After initial recognition, companies have two choices for subsequent measurement. One is the cost model, where the intangible assets is shown at cost minus accumulated amortization and any impairment losses. The second option is the revaluation model, where the intangible asset is shown at fair value. But this is only possible if there is an active market for the asset. Active markets for intangible assets are actually very rare. For example, fishing licenses or taxi licenses might have active markets, but most patents or trademarks do not. Now let's talk about the amortization. Amortization is the process of spreading the cost of intangible asset over its useful life, similar to depreciation for tangible asset. If the intangible asset has a two-finite life, it is amortized over the useful life. For example, if a patent is valid for 10 years, the company would amortize the cost of the patent over 10 years. On the other hand, if the intangible asset has an indefinite life like goodwill or some trademarks, it is not amortized. Instead, it must be tested for impairment every year. Impairment testing checks whether the asset has lost value if the recoverable amount is less than the carrying amount. then the difference is recorded as an impairment loss. So the sum up, intangible assets may not have physical form, but they are very important to in modern business. Companies like Google, Apple, and Facebook rely heavily on intangible assets such as software, patents, algorithms, and brand names. LKS 38 gives us the rules to recognize, measurement, and amortize these assets properly so that financial statements show a true and fair view of the company's value. Now I invite Tejaka to discuss calculation.
Okay. Question is given. We can read the question. XYZ Private Limited first patent for 1.2 million on 2023 January 1st. Useful life is 10 years. Residual value is given. Amortization method straight line. On 2025 January 1st, the patent was revalued to 1 million. Remaining useful life changed. They given to three questions. First one is calculate amortization for 2023 and 2024. Second one is revaluation adjustment on 2025 January 1st. Third one, the last one is amortization expenses for 2025 and carrying value at 2025 December 31st. Then we can solve them three steps. First one is calculate amortization year 2023 and 2024. Formula is annual amortization equal to cost divided useful life. Substitution equal 1.2 million divided 10. Then we can get the answer 120,000. And so each year amortization equal rupees 120,000. Then we need 2 years. Then 120,000 multiply by 2, then equal to 240,000. Total amortization, that means year 2023 and 2024 is 240,000. Carrying value at 2024 December 31st, 1.2 million minus 240,000, then equal 960,000. Then we can go second step, it's revaluation. Then revaluation on 2025 January 1st. Given fair value is 1 million. Then they given 1 million is the elevated amount. And carrying value before revaluation rupees 960,000. Revaluation surplus equal to 1 million minus 960,000 is equal to 40,000. Then this 40,000 rupees goes to revaluation revenue. Then we can go third step. It's amortization year 2025. Remaining useful life is now 10 minus 2 year, then equal to 8 years. New annual amortization. Formula is related amount divided remaining useful life. Then related revaluate amount equal to 1 million. 1 million divided by 8 is equal to 125,000. So amortization expenses for 2025 is equal to 125,000. Carrying value at year 2025 December 31st is equal to 1 million minus 125,000 is equal to 875,000. Then final answer, we can get amortization is year 2023 to 2024 equal to 240,000. Revaluation surplus is equal to rupees 400,000. 40,000. Then amortization year 2025 is equal to 125,000. Carrying value at uh, year 2025 December 31st is equal to 875,000 rupees. Then that's all our session. Then thank you.